Well, welcome to our Chapter 1 recording. I've got some information about our PowerPoint. Hopefully you've looked at the intro recording where I showed you kind of what the class layout was, and this is just the PowerPoint. You'll find it under our main page, and you'll find the handouts under the main page, and this is our Chapter 1 PowerPoint. So let's get into what is accounting. Well, here is the purpose of accounting right here. And I'm starting in the book, just so you know also, just right on page 4 of chapter 1, just kind of what we start with here. And what are the purposes of accounting? Well, we're accumulating information. We're measuring performance, we're communicating information, and we're facilitating informed decisions. So let me kind of just give you some background to this, okay? Just imagine a business, any business, and let me just pick on a mythical lawn mowing company that I might start. Okay, we'll call it Steve's Lawn Mowing. And let's imagine that I'm going to quit my day job and I'm going to go out and mow lawns. Okay, now obviously I'm not doing that in the winter. I'm going to be doing that in the spring and summer. Okay, and I'm going to buy the things I need. I'm going to advertise. I'm going to find people who need my services, and I'm going to start to mow lawns. Okay, and so accounting is accumulating financial data. Well, what does that mean? Well, that means as I mow lawns, I need to keep track of whose lawn did I mow, how much money did I collect, do I need to bill the person so that they'll pay me later, what about the things that I need to operate my business, like buying gasoline, buying supplies, buying the equipment that I need, buying advertising, insurance, maybe hiring somebody and paying them a salary. Okay, so I'm going to be accumulating all kinds of financial data. Okay, then every now and then I have to measure how did I perform. I'm going to measure this financial performance and see, was my business successful? Did I have a profit or a loss? How can we figure out what we can do better or different in our business? We're going to then communicate the financial information. We're going to discover that we will be giving financial information to outside third parties quite often, and we'll talk about who those groups are coming up, but we're going to give this information to others. And then the final one is facilitate informed decisions. How do we make a good decision? How do we know that a decision is a good one? Whenever it comes to my business, do I want to expand? Do I want to obtain a bank loan? Should I buy a better, more efficient lawnmower? Should I hire somebody? Can I justify hiring that person with new business? Things like that. Okay, so we're going to use information to make decisions. Okay, so what we're going to be doing with an accounting system, just track the daily business events that occur. Just think of any business that you frequent and think about how many transactions, how many events happen on a daily basis. Okay, you just go to Hy-Vee and imagine how many transactions occur where somebody is purchasing an item. Imagine Hy-Vee and it has to buy items from suppliers. It has bills it has to pay. Okay, the utilities, insurance, salaries, things like that. Okay, so we're going to track daily events. We'll analyze these events to determine if information should be captured in the accounting system. We'll use summarized information to evaluate how our business has performed. Okay, so we're going to analyze transactions, do day-to-day what they call bookkeeping, making journal entries, keeping track of things. You know, who owes us money, who do we owe money to, what's our current cash balance, things like that. Then evaluate the performance, including the financial health of the company. And so we're going to use what they call the decision-making process to do that. We'll identify an issue, we'll gather information, identify alternatives, and select the option that will most likely give us the desired objective. That's on the bottom of page 5. They also walk us through some information on page 5 about accounting and what it is and some of the decisions and so on. So who uses accounting information? There's really two main groups. Internal users, and then we're going to discover that there are also outside users, external. So internal, they call that management accounting, or the word management, right? We are giving information to managers so that they can better make decisions about our business. Okay, there's all kinds of examples of management reports: a budget, a cost analysis, a performance report, almost anything. A report of receivables, a report of payables, a daily cash balance report, a sales report. You name it, it's probably a management report. Okay, you would possibly be even to think of some management type reports that you are currently using in a business, also that maybe you've used at a previous job. What are some of those reports, and who uses them? Who prepares them and who uses them? Okay, now this class is going to focus primarily on external users. Okay, external users, which is really what this class is, financial accounting. Okay, those external groups, all kinds of them, investors, lenders, employees, customers, competitors, the government, the press, suppliers, anybody who we do business with or who relies on our business. Okay, they have a vested interest in how our business has performed. Okay, now the top two groups, the ones we focus on the most, are the investors and lenders. Okay, those are the groups we will primarily be tailoring our financial accounting information to meet their needs. Okay, investors is somebody who would invest in our business. A lender is somebody who would give us a loan. Employees makes sense, right? Employees of our business obviously have a vested interest in how our business is performing, if it's going to be around so they can keep their jobs. Our customers have a vested interest in how we perform so they can keep doing business with us. Our competitors want to know how we're doing. The government, especially in a regulated industry, we would be required to give them financial information. The press, suppliers, all have a vested interest in how a business has performed. Some examples then of the reports that we would give external users. Now, different than management accounting reports don't necessarily need to have a prescribed structure to them. They can really be whatever fits the needs of that company and management. Okay. Different with financial accounting though, when we are giving financial information to outside third parties, there's more structure to what we provide. And we provide specific kinds of reports with specific names: a balance sheet, an income statement, and a statement of cash flows. And there'll be a few others we might touch on later on. So the accounting cycle, and we're going to go through every single part of the accounting cycle here, and I apologize if that's kind of small as you're watching this recording, but you can definitely print out the PowerPoint or have it open also. So the accounting cycle, and you can see on the left side we've got internal reporting, which is the management accounting, which are financial reports that we generate for internal use. They really don't have a prescribed format to them. They can be whatever management needs. Then in the middle there, the second box, the yellow box, general purpose financial statements for use by creditors, investors, and external users, would be a balance sheet, income statement, statement of cash flows. And we'll talk about those financial statements and how we prepare them later on and what they mean. And then finally to external reporting, which is the full financial accounting scale here, which is producing other reports like a publicly traded company. A publicly traded company is any company that we can buy the stock of. Those companies have to file with the Securities and Exchange Commission. They're required to. There's special kind of statements that need to be filed quarterly and annually. We need to provide information to the IRS and any other regulatory agency depending on what industry the business is in and who is regulating the business. Okay, so the rules of the game for external reporting, anytime we give financial information to an external third party, we have to follow a set of rules. We call that GAAP, G-A-A-P, which is Generally Accepted Accounting Principles. Okay, so that is required. That has to be that way. Internal reporting, there's no rules. So when it comes to management reporting, it's really up to the business to decide the format of those reports and what they will look like. Okay, and I should also mention that this information is in your book on pages 8 and 9. So who makes the rules? Okay, who makes the rules here? Well, the biggest group is the FASB, the Financial Accounting Standards Board. Okay, used by U.S. companies. There's also an international version of that called the IASB, and they prepare an international version of the accounting rules. There will be a point in time where the U.S. And the rest of the world will be using the same principles, but we're not quite there yet. So when you hear the FASB, that's the Financial Accounting Standards Board, FASB. Okay, and you can see kind of all the different parties that have input into what the GAAP, Generally Accepted Accounting Principles, are. Okay, so when I say GAAP, I mean GAAP, Generally Accepted Accounting Principles. Okay, the top one, the FASB. This information, if you want to read more about each one of these groups, is on pages 12 and 13. The FASB is a private board. They're based in Connecticut, and they've got some full-time members with a variety of different backgrounds, elected or selected to the board, and then their job is to really create the accounting rules. They have a very slow and deliberate process that they go through to do that. They do not make them quickly. They make them slowly and deliberately on purpose. Okay, and they definitely will write up a rule, put it out there for public comment, take feedback, take that into account, maybe change the rule as needed, and then go ahead and also, again, they would then take more feedback and so on, and ultimately there'd be a vote. On the right side then, let's go around the circle, the PCAB, which is the PCAOB over here. I call it the PCAB, Public Company Accounting Oversight Board. They were created by the Sarbanes-Oxley Act back in the summer of '02, and their job is to regulate auditors and make sure that auditors who audit publicly traded companies are doing their job the right way. The IRS, of course, we all know the taxing authority in the United States, and they have a set of prescribed tax rules and so on that affect companies, obviously. The AICPA is on the bottom, the American Institute of Certified Public Accountants, and that is an industry trade group. Okay, it's basically of CPAs by CPAs. Okay, and their job is to help CPAs be better at their jobs. They provide a lot of industry training. They also have a lot of input in terms of the CPA exam and the questions on the CPA exam. But really they provide just kind of an association of accountants for education. CPAs have to have 40 hours a year of continuing ed. The AICPA is a very big provider of some of that information and education. And then this SEC, the Securities and Exchange Commission, right here, that is a government entity created back in the early 1930s as a direct result of the stock market crash of 1929. And what they do is regulate publicly traded companies. So any company that you and I can buy the stock of, they are subjected to the SEC's rules and regulations, which requires quarterly and annual financial reporting, and it also requires audits be done of the company's financial records. And the SEC actually has the power by Congress to create GAAP accounting rules. However, they don't do that very often. They typically let the FASB do that. Okay, and so it's very rare that they would create an accounting rule. They generally let the industry take care of itself. The last one is the IASB, which is basically the international version of what we call the FASB in the United States. Okay, some other factors that kind of go into accounting. Ethics is a very big one that we'll definitely be touching on throughout the class. Professional judgment. You know, it's all about professional judgment, and to be a CPA, you have to pass an ethics exam. Ethics is important in accounting for a number of reasons. You know, think about how many different external parties rely on the financial statements of a business. We had a big list there, and a couple of the biggies were, investors, and lenders. So let's say I'm an accountant for a business. I'm preparing financial statements. What if the financial statements that I issue to external parties, what if those are bad in terms of maybe I know my business isn't doing very well, and so I'm going to embellish the numbers and make them look just a little bit better than they really were, than they really are. And I'm going to do that so that I can get this bank loan. Okay, otherwise I know if I don't get this loan from the bank, my company may go belly up. Okay, well, that's not ethical, right? And so that's why accountants have a very high ethical standard to uphold, is because external parties rely on the work of accountants and their professional judgment. So accountants have to be what I'll call transparent, and that is when we issue the financial statements to external users, we're basically saying these are the numbers, good or bad. We're not hiding anything. That's what we mean. That's what we mean by being transparent. We're not hiding anything. We're showing everything that the company has done. You know, reporting, here's how we did this year, good or bad or otherwise. Okay. And they mentioned Enron here, another company, WorldCom. We had some very, very big failures back in the early 2000s, late 90s and early 2000s. Some very, very bad ethics judgments by some key figures at these companies. Enron and WorldCom were very large and at the time respected corporations. And what happened is that the top management of each company intentionally falsified financial information in order to produce financial statements that looked really good, in order to make stock prices go up, and in order to attract new loans. Ultimately, both were caught, and it became apparent that the top management was guilty. People went to jail. And so Congress, because of this behavior, the stock market took a dive, and Congress passed the Sarbanes-Oxley law back in the summer of '02, which created the PCAB, that Public Company Accounting Oversight Board. And the purpose of Sarbanes-Oxley law and the PCAB, which was created as a part of Sarbanes-Oxley, is to require more internal auditing, to require top officers of a company to sign off that the financial statements are accurate, and if not, there are very specific penalties that were put in place, both criminal and civil. In addition, another big ethical lapse that happened with Enron and WorldCom was that their auditor, their public auditor, a firm called Arthur Andersen, knew about it, but they did nothing to stop it. And the reason for that is Arthur Andersen was both a consultant and the auditor for these companies. Okay, and they made a lot more money on consulting than they did with the audit fee, and they basically were just throwing in the audit fee for really and not charging much. Okay, they were making a vast amount of money from Enron because of doing consulting, and they didn't want to lose that. And so Arthur Andersen was no longer independent. External auditors must be independent, okay, and they were not anymore. And so they never challenged management of Enron to say, what you're doing is wrong, we know it, we can prove it, and we're going to report you. They never did that. And so when Enron finally was outed and discovered, Arthur Andersen started shredding their evidence. And so that firm no longer exists, which is a shame. And part of the Sarbanes-Oxley Act and the PCAB being created was to kind of just bring back some ethics and make ethics more important, and just make sure that public auditors have a little bit of regulation to make sure that they are doing the right thing. Okay, some activities common to business organizations. Just think about any business and think about what kind of transactions are going to happen, what kind of things are occurring within the business that results in accounting needing to happen. Okay, and what you see right here is back on page 7 of your chapter, and at the top you can see, investors, owners can make investment in a business, or business can find outside investment. We would obtain loans, and that would give us some money, some capital to start our business. Okay, that capital then is used to buy the things we need to start our business. Let's go back to my mythical lawn mowing company example. And let's envision that I'm going to start my own lawn mowing business, and I've got some of my own money I'm going to put in the business, and I also am going to go out and get a bank loan. Okay, so let's say I'm going to borrow some money and invest in my own business. Then I'm going to buy a big fancy truck and a big fancy riding lawnmower and a trailer to haul it all around. Okay, and then I'm going to, of course, down here in the bluish row here, buy the things I need. Okay, so I'm going to buy the equipment that I need. I'm going to buy some supplies and materials, maybe a small lawnmower, some rakes, fertilizer, whatever else I might need. Maybe I'm going to hire some employees and pay them. Maybe I'm going to rent a shop where I can store everything. I'm going to pay for advertising, pay some utilities, definitely pay for insurance, things like that. And then I'm going to have my service ready to bring to market, by advertising. And then hopefully I find customers, right? And then as I deliver services to my customers of mowing lawns, they pay me, of course, so I get some money now. And then I'm going to take that money that I earned from delivering my service of mowing lawns to pay my bills, pay off any loans, pay my taxes, provide a return to owners, and then continuously pay for my operating expenses. And ultimately, as I earn money, as I have earnings, my capital goes up. Okay, so that's really what we're going to be doing, is accounting for every step of this throughout this class. Okay, and so why should I learn accounting? Well, everybody makes financial decisions, and it's interesting because even if you've never had an accounting class in your life, we all hopefully are making money somewhere, right? And as we're making money, we need to figure out, where should that money go, right? I need to have a budget in just my personal life. What should I be spending my money on? We all have limited resources, so how will we use those resources? If I have excess money, what should I do with it? What should I invest it in? If I need to buy something, buy a home, buy a new vehicle, what makes more sense? How would I get the best financing? Should I buy it or should I lease it? And accounting will help us with all these things. So, we're going to talk about it applying to a business, but in reality, we can apply a lot of these accounting concepts to our individual and personal finances. Okay, so that's chapter 1, and hope it makes sense. Basically, once you're done reading a chapter and listening to this, then the next thing to do would really be to go into the Cengage Now website and then work on the chapter 1 study plan, or whatever chapter you're listening to, and work on that study plan and just see how that goes. And if it's kind of a struggle for you, if you're not quite getting it, then I always say stop, come back and study again. That would involve reading the chapter again, listening to the recording again, and I'll provide some other study materials also, and just reviewing everything and making sure that you understand what you should be doing. Okay? Thank you.